Compounding is the ability of an asset to generate earnings, which are then reinvested or remain invested with the goal of generating their own earnings. In other words, compounding refers to generating earnings from previous earnings. The reason I'm talking about compounding is that it'll help to frame your understanding of and is one of the main advantages of dividend reinvestment plans. So let's get into what a dividend reinvestment plan is. Dividend reinvestment plans allow you to automatically reinvest cash dividends in new shares rather than receiving the dividends in cash. Companies that offer dividend reinvestment plans allow shareholders to reinvest some or all dividends in new shares, which are sometimes issued at a discount to their listed share price at the time, if you're lucky. Dividend reinvestment plans and distribution reinvestment plans are both known as DRPs. The term distribution is often associated with ETFs, but it works essentially the same as dividends. So in this case, just consider it a synonym. When you buy shares in a company that offer a DRP, you can opt in or out by changing your preferences online through the share registry website. You don't have to pay any brokerage, commission, or other transaction costs for these new shares, and they are automatically issued to you under a DRP. The new shares will be listed on the stock exchange and rise or fall in value the same as any other shares in the company. Companies have the option to retract an option for you to participate in a DRP at any time, so there's no guarantee that you'll be able to keep reinvesting your dividends or that you'll receive future dividends at all. Some of the advantages of using a DRP for investing are that you won't pay brokerage on the additional shares issued under the plan. It's a great way to automate and keep reinvesting the income you receive on a regular basis. It grows your investment over time and you take full advantage of the effects of compounding. There may be potential discounts to the share price on the share units issued under the plan if the company says they will allow that. Some of the disadvantage of using DRP for investing are that it can be more complicated for record keeping purposes as you need to keep on top of your shares and their costs for capital gains tax purposes. Also, you have no control over the price at which the shares are allocated to you at the time. You don't receive the cash dividend, which you may need to supplement if you're relying on that money. If the share price is quite high and your dividend is less than that amount, you won't be issued fractional shares. Instead, the registry will hold on to your fractional entitlement and roll it over until the next DRP allocation. So in case I missed some parts while explaining DRPs in this video, I've gone to a frequently asked questions section for Coles Group Limited, which is an Australian company and it's a high dividend payer for the most part. So what we've got here is frequently asked questions, things that's explaining what I've already explained, what is the DRP, and how does it work. Then we've got, is it optional? Yes, you're not going to have to participate in a DRP. As already mentioned, you can get the cash dividends, and that's what I think most people probably do who can participate. We've got some residency rules here, but you'll also find that there are some rules around how much you have invested in the company usually as to whether you can continue getting new shares with your dividend. I think something like the $50,000 mark is usually the figure we're looking at there. How do you participate in the DRP? So the share registry that looks after Coles stock, and it's quite a big one in Australia. One of the more common ones is Computershare. So basically, if you owned Coles stock, you could head to this website for the registry, log in, and from there, it's basically going to be opting in. You tick and flick and say that you want to participate in the dividend reinvestment program. Again, do you have to participate? No. It's important here to note that for the most part, for most stocks, there will be a couple of options in that you can fully participate, and that's going to be all of the dividend that you receive gets reinvested into new shares, or you can partially participate. This is where you would elect some of the money that you receive through dividends to be reinvested, and the rest of it you would just receive in the normal cash. If you have more than one shareholding, they're potentially going to have different share registries. So that's just a matter of looking at which registry is aligned with which stock. you'll go there and either participate or choose to not participate in a DRP. Can you withdraw and change your participation at any time? It's usually not a problem for the most part. Again, going to the registry and saying you don't want to participate in the program anymore. So, what will the price be of the shares allocated under the DRP? This is another important one. It's going to normally depend. They take what we've got here is not less than 10 trading days. They're going to take an average around the dates from when you are on the books, so not ex-dividend. And it's going to just depend on what that week has in store. Sometimes it's going to be high, sometimes lower. It really just depends. And some companies will offer you a discount on the market price of the shares. That'll usually be outlined on their dividend announcement at the time. It's pretty rare that they're going to have a discount be a consistent figure year over year. So that's just a few things. If you wanted to have a look at whether you can participate in a DRP for a dividend paying share that you hold, I would just head to its investor center on its website, something like that. It's going to have a outline like this. You'll head to the share registry, turn it on, and go from there. At the end of the day, participating in a DRP may not be suitable for all investors. If you're an investor looking for regular income, possibly for retirement, you'd likely prefer to have your dividends paid in cash. Also, because you don't have the ability to control when and at what price your additional shares are acquired under a DRP, you may prefer to take the cash and reinvest it when you feel most confident and comfortable. As a fairly passive long-term investor, I'm a fan of DRPs in most cases, but everyone will have different goals and timelines to take into consideration.
Hey, thanks for watching. If you like this video, please like and subscribe. If you didn't like the video, that's okay. Please still subscribe and I'll continue trying to improve to win you over. We're just getting started.